So now you see that this is the at the money line, and that you only see red if it goes down in this direction. You see that red here. This is your loss zone there. But if you're going up, you see it, the green continues. And normally when we're doing an iron condor, and I'm just going to set this up so you can see it on the screen right now. This is not the strikes we would normally use. But normally when you're setting up an iron condor, it looks similar to this. All right. So I'm going to just set up a 5-point wide here, and let's just do it like this. Right. So this is you can see all the legs on your screen. That's why I'm doing it this way. Right? And so when you're doing an iron condor, you are selling a bull put spread. This is the bull put spread right here. And then you're selling a bear call spread. And this is the bear part here, right? Because whenever you sell a put or anything on the put side, it's bullish. Whenever you sell anything on the call side for a net credit, it's bearish. So you can see that you have a 5-point wide here, and you have a 5-point wide here. And this, I just say these are basically the same delta, right? I just say it's both 43 on both sides. Well, that's a traditional iron condor. The deltas on both sides of the short leg are the same. The width of the spread are the same. It's a traditional iron condor that you want it to stay in between your short strikes. So this is the short strike on the put side, the 517. Then this is the short strike on the call side, the 525. The stock is currently trading at 520. Did I just say it? Close, 520. So you want it to stay in between there, and if it stays in between there, that's how you win, because an iron condor is inherently neutral, meaning that you're not bullish on the underlining, you're not bearish on the underlining. You think it's going to stay in a range, or it's at least going to stay within your short strikes within that time frame of the trade. So if we were doing this trade, it would be 58 days from now. We would think it's going to stay in that range. So this is how it looks on your screen if you were going to be doing it like this, but obviously we won't sell these type of strikes. This would be a bad iron condor to sell. But just to go to this curve view, I'm going to make this a little bigger so that we can see this. All right, so you can see here that this is the at the money line. Okay? And that if it goes down on the traditional iron condor, you can lose if it goes down too much. This is your loss zone. If it goes up too much, you can also lose. But if it stays in this range here, this is where you have your win zone. This green zone here is your win zone. So it's inherently neutral. You don't want it to go down too much. You don't want it to go up too much. An iron condor has defined risk, because if it goes down, you don't have risk all the way to zero because of this put that was bought. This put that was bought is kind of like a built-in hedge, a built-in stop loss. You don't have theoretically unlimited risk to the upside because of this call that you bought. That's your built-in stop loss, right? That's your defined risk on this trade. So that's why your win zone is this and your loss zone is like this. Right? So that is a traditional iron condor. But when you go and you do a no upside risk iron condor that we consider a swing trade, 30 to 60 days is our typical swing trade. A swing trade can be longer than that, and it can technically be shorter than that. But at the Dorian Trader, our bread and butter, we consider 30 to 60 days. And if we were going to do a no upside risk iron condor, we will set it up very, very similarly than what we just did, except we're not going to have obviously any risk to the upside. So the iron condor is going to be what is called skewed. It's more of a directional iron condor that is still inherently neutral. And I know that kind of sounds like a oxymoron or a contradiction because I'm saying we're neutral, but we're directional, right? And I'll explain that more here in a second. So the way we normally set up a no upside risk iron condor is selling at or near the 30 delta on the call side, selling that call spread, that bearish part of the iron condor at or near the 30 delta. That's normally. And so we're normally selling it between a 1 and 5 point wide spread. So in this case, we're going to sell the 31 delta and we're going to buy the 537 or one strike higher on an option chain. So this is going to be a 1 point wide spread. Each point when you're dealing with options on stock is $100. So you take the 1 times 100. And so the most you can lose on this call side before the premium received is $100. So if your overall trade if you collect more than $100, then you're going to have no upside risk. And I'll show you that here in a second. So if we go down here and we set it up on the way we set up our swing trade, we're going no higher than a 15 delta. So let's just say in this example, we're going to go to a 15 delta and we're going to do a 10 point wide here. So this iron condor is skewed in a couple ways. It's skewed based on the width of the spread of each side, and it's skewed based on the deltas on both sides. So in this example here, we would buy that. And so this is a 10 point wide spread. So 10 times 100 is $1,000. So that's the most we can lose on the put side before the credit we receive. But in this example, we are receiving $107. And I just lock it at that, right? The most we can lose on the call side is $100. We are collecting, someone's giving us 107 before fees and commissions. So that means we're going to make $7. Worst case scenario, if the market shoots all the way up, we're still going to make $7 before fees and commissions. So if we go back over here to this curve view on the TastyTrade platform, you're going to see how this is set up. I'm going to make this a little smaller so that you can see this. And I'm just going to move this back a little bit. All right, so there you go. So now you see that this is the at the money line, and that you only see red if it goes down in this direction. You see that red here. This is your loss zone there. But if you're going up, you see the green continues. Right? We're not going to have any loss zone on the call side of this iron condor because you're collecting more than what you can lose on this bear part of the iron condor. Right? You're collecting more than you can lose there. But I said this trade is a directional iron condor, but still inherently neutral. And that sounds like a contradiction, but this is why you want it to stay in between these two short strikes. This is the put short strike and this is the call short strike, because if it stays in between there, this is where you make the most money. This is where you can make the credit, the entire credit that you received on the trade. If it stays in between this, if it goes up too much, you're going to still win, but you're not going to make as much as you can if it stayed in this kind of neutral area of the trade. Okay, that neutral area of the trade. So you still want it to stay in between your short strikes, but you're not panicky if the market goes up a lot like it has for the last 5 months and now going back up today. Okay, you're not panicking because you don't have any risk to the upside. Your risk is only to the downside on this trade. That's why, or hence why we call it the no upside risk iron condor.